Hi students, welcome to the video on analysis of financial statements at your fingertips. Already in the previous videos we have discussed two important financial statements. One is balance sheet. As a mirror reflects the face of a person, balance sheet reflects the financial position of the concern, showing assets on one side and liability on other. So it is otherwise known as position statement. Then from profit and loss account, that is income statement. So the main purpose of running any business is to maximize profits. So profit is the lifeblood of every business concern. In this video, we will focus on the balance sheet, that is position statement, and statement of profit loss, that is income statement of company. So regarding preparation of balance sheet and trading profit loss account, there is no hard and fast rule in which way you arrange the, suppose in balance sheet, in which way you arrange the assets. You may arrange the asset in terms of first current asset, then fixed asset, then non-current asset, then fictitious assets. Similarly in the liability sides, capital fund, that is shareholders fund or owner's capital, share capital. Then non-current liability, current liability, like this. But as per Companies Act 2013, it is mandatory to prepare the income statements and balance sheet in a vertical form. So first, what is the purpose of preparing those financial statements? First is we have to analyze the data. What are the data given? How much is the gross profit? How much is the operating profit? How much is the net profit? That is our motto. Then from balance sheet, how much is the shareholders fund? How much is the borrowed fund? Then how much is the fixed assets of the business, investment, then working capital position. So this we will analyze from balance sheet. So in the given video, ABC Company Limited vertical income statement for the year ended 31st March 2023. Income, sales or revenue from operation. So first we will take revenue from operation, that is net sales. Sales less sales return or return inward. So sales was 1 crore 10 lakh minus sales return 5 lakh. So net sales or revenue from operation is 1 crore 5 lakh. Then from sales, net sales, we will deduct cost of goods sold. So cost of goods sold will be calculated by putting opening stock here 25 lakh, add purchases 75 lakh, add wages 5 lakh, add carriage inward, means carriage and purchase 1 lakh, then direct expenses 2 lakh, less closing stock 30 lakh. So net cost of goods sold is 78 lakhs. Here it is 1 crore 5 lakh, then we will deduct 78 lakh. So gross profit is sales minus cost of goods sold, that is 27 lakhs. Then from gross profit we will deduct operating expenses. Operating expenses are those expenses which are required for running the business, operating the business or making the business in a profitable position. First is administrative or office expenses. All expenses relating to office, it includes salaries, all welfare benefits, rent, taxes, insurance, a factory, whatever may be insurance of that office, whatever expenses under office and administrative, it is included here. Then finance expenses, that means interest on borrowed funds, then all are charges charged by the financial institution, then selling and distribution overhead, all expenses related to salesman salary and advertisement expenses, discount on issue of or sale of goods, then commission to the salesman, all are selling and distribution expenses. So total is administrative expenses 5 lakh, finance expenses 3 lakh, selling and distribution is 2 lakh, so it is 10 lakh. Total operating expenses 10 lakh. From gross profit, if we deduct the operating expenses, we will get operating profit. Here operating profit is 70 lakhs. Then in the business, there are some non-operating income, non-operating expenses. Non-operating income means income not related to business. Suppose we have invested in somewhere, then we will get the return, that is interest on that investment. Similarly, profit on sale of fixed assets, that will come under non-operating income. Here it is 2 lakh. Then similarly, there are non-operating expenses like loss on sale of assets, that is 1 lakh we have deducted. We will get net profit before tax 18 lakh. So tax provision, it is presumed at 50%, that will be charged on net profit before tax. So 50% on 18 lakh is 9 lakh. So net profit after tax of this company is 9 lakh for the period ended 31st March 2023. Then we will prepare balance sheet of ABC Company Limited as on 31st March 2023. You know, profit loss is prepared throughout the year, that's why it is written year ended 31st March 2023, but balance sheet is prepared as on a particular date and generally at the end of the financial year, so it is written balance sheet as on 31st March 2023. In the balance sheet, first we have to know what are the sources of funds, then what are the application of funds. So total of sources of funds, that is total of funds available, should be equal to total of funds employed or applied. So sources of funds, first we have to calculate owner's fund or shareholders funds. Owner's funds or shareholder fund includes share capital first. Under share capital, equity share capital, preferential capital. You know, equity shareholders are the owners of the company. They elect the board of directors to operate or run the company. Then preference shareholders are the investors on fixed rate of dividend. Then in case of preference shareholder, they will get first preference regarding payment of their interest or dividend and also principal in relation to equity shareholders. Then in case of preference shareholders, some are redeemable, some are irredeemable. If it is redeemable, after a certain period, say 5 years, 7 years, their capital will redeem. That means their capital will be purchased by the company. And sometimes some preference shares are participating. If they are participating, then they will participate. After getting the normal rate of dividend, they will participate along with the equity shareholder to get extra dividend. If they are not participating, they cannot participate. Then convertible, non-convertible. If preference shareholder are convertible nature, they can convert their preference share into equity share. Then there may be preference shareholders who will be interested to convert their preferred share to equity share because if they are convertible in nature. Then reserve and surplus. Reserve surplus includes profits and loss account, then general reserve, security premium, etc. Less from the reserve surplus we have to deduct fictitious assets. Fictitious assets are those assets which are not actually assets but it arises due to suppose goodwill, patents, copyrights, trademarks, then discount on issue of debentures, preliminary expenses written off. These are fictitious assets. Fictitious assets will be deducted from reserve and surplus. Other reserve share capital plus reserve surplus less fictitious asset will give us net worth or owner's funds. Then borrowed fund. Borrowed fund includes bank loan and debenture. Debenture is an acknowledged debt of the company and debenture holder get the fixed rate of interest on their investment. They are the creditors of the company. So total owner's fund plus borrowed fund gives us total funds available for the business which is known as sources of fund or inflow of funds. Then after getting those funds we have to apply those funds in various heads. One is fixed assets. Fixed assets are those assets which gives benefit for a longer period of time, say more than 1 year. Loan, building, plant and machinery, furniture fitting, vehicles. Land and building, plant and machinery, furniture fittings, vehicles will be shown at their net figure. Means depreciation will be deducted from these heads. Net fixed assets will be shown. Then investment. Then working capital. Working capital includes current assets minus current liability. That means excess of current assets over current liability is working capital. In the current asset, we have to divide it under two heads. One is quick asset, another is non-quick assets. We have already discussed in the ratio analysis what is current ratio. Current ratio is the ratio of current asset divided by current liability. Then in case of current ratio, suppose the ideal ratio is 2:1. But if the current ratio includes major portion of inventory or outstanding expenses, prepaid expenses, then it will be not suitable for the investors. That means the liquidity position will be very poor. That's why we have to calculate the quick assets, quick ratio, that is quick assets by current liability. Quick assets includes cash in hand, cash at banks, and debtor, bills receivable. It does not include inventory and prepaid expenses. Prepaid expense inventory are non-quick asset. In this case, the ratio should be 1:1. Then under quick liability, current liability is also divided into two ends. One is quick liability, that is sundry creditor, bills payable and outside expenses. These are quick liability. And non-quick liability is bank overdraft, because we have already told working capital gap is equal to current assets minus current liability excluding bank borrowing. So bank borrowing is excluded here to get the ratio or refined ratio, that is quick asset by quick liability. Then we will total both current assets, deduct total of current liability, that will give us working capital. So in application of funds, we will take fixed assets plus investment plus working capital, that will give us total funds employed and applied. So it is based on the equation every time asset is equal to liabilities plus capital. That means the claim of outsider against the asset is known as liability. The claim of owner against the asset is known as capital. Thank you for watching this video. In the next video, we will discuss the partnership business or partnership firm, then regarding admission of partners, retirement of partner, death of partners.